So last Friday, the markets got absolutely rocked by a shockwave, a massive sell-off that seemed to pop up out of nowhere. But here's the crazy part. What if I told you it was all triggered by a policy that, on the surface, sounds like fantastic news? Let's connect the dots.
It all kicked off with this one, brutal number, negative 11.4%. That was gold's biggest single-day drop in decades. Just a shocking gut punch of a plunge that left traders absolutely reeling.
But believe me, that was just the start. This wasn't just about gold. No, this was just one piece of what's being called a brutal four-way slaughter, a simultaneous crash across stocks, bonds, gold, and silver.
All right, so what in the world just happened? Let's get into it. Let's really unpack this market crash and get to the bottom of all this chaos. This is the story of that brutal four-way slaughter. And it really was a bloodbath. You had the S&P 500, right? It just barely kissed that 7,000 mark before it completely turned tail and closed deep in the red. Big tech got hit the hardest. We already saw gold's insane 11.4% plummet, and silver crashed an astonishing 31.4%. That's its worst day since the 2008 financial crisis. So, what could possibly cause this kind of widespread panic? Well, it all points back to one thing: the official nomination of this guy, Kevin Warsh, as the next Fed chair. The big question is, how on earth does one person's nomination cause a market earthquake like this? Well, it all boils down to his signature policy. And let me tell you, it is a real paradox. On one side, you've got a promise, and on the other, there's a serious hidden threat. Let's dig into this so-called dual-track paradox. So this whole thing, his dual-track framework, it's built on two ideas that just don't seem to go together. On one side, you've got the promise, the shiny object, rate cuts. That makes borrowing cheaper, lowers the price of money. Sounds great, right? But then you've got this hidden engine, quantitative tightening, or QT. And what that does is it literally sucks the volume of money right out of the system. And the insiders, the people who really get this stuff, they're calling it a lethal price-volume divergence. The price of money is going down, but the actual amount of money is just disappearing. That's a recipe for some serious instability. So that brings us to the million-dollar question, right? What in the world happens when the price of money drops, but the actual supply of money is just gone? How does that even work?
Okay, so to understand that, we have to look under the hood. We're going to go inside what's being called the dollar shredder to see how the Fed can literally just cancel money.
The fancy term for this is dollar liquidation, but what it really means is pretty simple. The Fed gets cash back from its old bonds, and instead of putting that money back to work like it usually does, it just, poof, deletes it from the books. And the immediate result is that bank reserves, the actual cash banks have sitting around, starts to shrink.
And it's this weirdly simple three-step process. Step 1, the Fed gets a big pile of cash from bonds that are maturing. Step 2, it breaks with tradition and says, nope, we're not reinvesting this. And step 3, the wildest part, that cash is just canceled. It's gone, shrinking the whole money supply. It's like a financial black hole, for real.
And that is why the market is freaking out. Because a market rally without any actual cash to support it, it's like building a castle on sand. You can promise cheap money all day long, but if the well is dry, if there's no actual liquidity, the whole structure can just collapse.
But here's the thing about risk. It doesn't just disappear into thin air. It has to go somewhere. And under this plan, the Fed is basically tossing that hot potato right over to the banks, and it's a really dangerous trade-off. They're calling it the regulatory and profit swap. And honestly, you can think of it like a deal with the devil. The banks get what they want, less regulation, a chance at bigger profits, but the price they have to pay is absorbing all the government debt risk the Fed doesn't want anymore. So you can see the trade-off right here. The reward, that's the bait, is looser rules and bigger profits. But the price, and this is the trap, is that the banks have to soak up all this government debt, taking on a whole new level of systemic risk.
So what's the bottom line? Well, you're making the entire commercial banking system super fragile, super sensitive to the slightest shock. You're basically trading the stability of the whole system just to solve a government funding problem.
So let's bring this home. What does all of this mean for your money? Is this some brilliant move, or is it just a sugar-coated bullet aimed right at the heart of the economy? Because in this new Warsh era, the old playbook might get tossed out the window. For stocks, you've got to be wary of those high-flying growth companies that live on cheap debt. Instead, you might want to look at companies with massive, reliable cash flow. For bonds, it could be good for the short-term stuff, but maybe not so great for the long-term. And with real assets, it's all about one thing: finding things that generate stable, predictable cash.
And this is really the heart of it, isn't it? The public just sees the headline, rate cuts, which sounds fantastic. But the insiders, the people who know how the financial plumbing actually works, they're terrified of the liquidity vacuum that's being created just out of sight.
And that's the ultimate gamble here. Trying to build prosperity by sacrificing bank stability, well, that could just be setting us up for way bigger shocks down the road. It's like solving today's problem by creating a monster for tomorrow.
So I'll leave you with this question. Are these rate cuts really a cure for what ails the market, or are they just the bait for the next big crisis? And you have to wonder, what happens when the very banks holding all our savings are the ones being forced to take this gamble?